January 2026. An unconfirmed rumor, just whispers, no footage, no official statement, moved $11 per barrel in 2 hours. Oil traders didn't wait for facts. China called an emergency press conference. Russia demanded a UN Security Council session. 40 countries accelerated plans to exit the dollar. That's not market overreaction. That's the moment the world admitted what it already believed. This isn't about whether Maduro was captured. The Pentagon never confirmed. Caracas showed him alive days later. This is about why the rumor was enough, why belief moved faster than truth, and what that reveals about how the dollar actually works. Picture a trading floor in Singapore, 2:47 a.m. local time, January 3, 2026. Marcus Chen, a 34-year-old oil futures analyst at Trafigura, is staring at his Bloomberg terminal. He hasn't blinked in 11 seconds. His coffee sits untouched, growing cold. The number on his screen doesn't make sense. Brent crude just jumped from 76.23 to 79.41 in 90 seconds. No pipeline explosion, no tanker attack, no OPEC announcement, just a Reuters alert with 2 words that changed everything. Maduro detained. Marcus picks up his phone. His hand is shaking. He calls his risk manager in Geneva. "Are you seeing this?" The line is already jammed. Everyone is calling everyone. And nobody knows if it's real. 6,000 miles away in Caracas, Rosa Mendez is waking up to her phone buzzing. She's 52, a former PDVSA accountant who lost her job when U.S. sanctions collapsed Venezuelan oil production. She now runs a small grocery store that accepts bolivars, dollars, yuan, and sometimes just eggs as payment. Her daughter in Miami is texting frantically. "Mom, they're saying the Americans took Maduro. Get out. Get out now." Rosa walks to her window. The street is quiet. No tanks, no soldiers, no helicopters. Just the same broken streetlight that's been flickering for 3 years. She texts back, "I don't see anything." But she starts packing a bag anyway, because in Venezuela, you learn to pack before you understand why. Here's what most people get wrong about this moment. They think markets move on facts. They think price reflects reality. They think information travels, gets verified, then gets priced in. That's not how it works. Markets move on belief. And on January 3, 2026, the entire global financial system believed for several terrifying hours that the United States had militarily captured a sitting president to enforce the petrodollar. The claim was never officially confirmed. The Pentagon issued no statement. The White House press secretary said only, "We do not comment on ongoing operations." That non-denial denial. Those carefully constructed words designed to neither confirm nor deny. The kind of language that makes you certain something happened precisely because no one will say it didn't. Within 2 hours, oil had spiked $11 per barrel. Gold jumped $48 an ounce. The Brazilian real fell 3.2%. The Turkish lira crashed 4.1%. China's foreign ministry held an unscheduled press conference at 2:47 p.m. Beijing time, 14 minutes after the first Reuters alert, demanding immediate clarification. Russia's UN ambassador requested an emergency Security Council session. Iran's supreme leader posted 6 words that would be retweeted 840,000 times before sunrise. Venezuela today. Who tomorrow? Imagine the scene in central banks across the developing world. In Riyadh, in Jakarta, in Pretoria, in Buenos Aires. Officials pulling up dollar reserve positions on their screens. Doing math they'd hoped they'd never have to do. Asking questions they'd been avoiding for years. If this can happen to Venezuela, even if we're not sure it happened, what stops it from happening to us? And here's the first question that should keep you up at night. If an unconfirmed rumor can move oil, $11 in 2 hours, crash emerging market currencies and trigger diplomatic panic across 40 countries, what does that tell you about how the dollar system actually functions? Abdullah al-Rashid still remembers the exact moment his perspective shifted. He's 58, a senior advisor to Saudi Arabia's sovereign wealth fund, managing a portfolio worth $940 billion. He was in his Riyadh office prayer rug still rolled in the corner from Fajr when his deputy rushed in with a tablet showing the oil spike. Abdullah had spent 30 years building dollar-denominated positions. Treasury bonds, U.S. equities, dollar deposits in New York banks. He'd always believed the dollar was safe because it was strong. That morning, watching the chaos unfold, a different thought crystallized. The dollar isn't safe because it's strong, he told his deputy. It's strong because leaving it isn't safe. He paused. Those are not the same thing. That distinction between strength and enforcement is what this video is about. By noon Eastern Time, Venezuelan state media showed footage of Maduro at an undisclosed location speaking to supporters. He appeared calm. He called the reports psychological warfare. He was alive, apparently free, apparently still in power. The immediate crisis passed. Markets partially recovered. Headlines moved on. But something had broken. Something that couldn't be unbroken. The scene that haunts me is from a Reuters photograph taken 3 days later. Christine Lagarde, president of the European Central Bank, walking into an unscheduled meeting in Frankfurt. Her face is composed, professional, but her hands are clasped too tightly, the body language of someone who just learned the rules changed while she was sleeping. The official topic of the meeting was financial stability coordination. The real agenda, according to 3 sources who spoke on background, was a single question. How exposed is Europe to a dollar system maintained through force rather than trust? Here's the second question most people never think to ask. For 50 years, we've been told the petrodollar works because it's efficient, liquid, stable, because it's the best option. But what if the petrodollar works because the alternative is having your president captured your assets, frozen, your economy strangled? What if we've been confusing voluntary participation with coerced compliance? Perception is reality in financial markets. If enough people believe something is true, they act on that belief. Their actions create real consequences. And the consequence of January 3, 2026 was this: 43 countries accelerated plans to reduce dollar exposure. Not because they knew what happened, but because they knew what could happen. And that was enough. One person who understood this immediately was someone you've never heard of. Her name is Dr. Mei Lin. And in January 2026, she was a 41-year-old economist at China's State Administration of Foreign Exchange, the agency that manages China's $3.2 trillion in reserves. We'll come back to her later. Because what she recommended in a classified memo 3 days after the Maduro incident would set in motion a chain of events that's still unfolding. She didn't know it at the time. She thought she was just doing her job, analyzing risk-making prudent suggestions. She had no idea she was drafting the blueprint for ending American financial hegemony. But before we get there, you need to understand something. The Venezuela incident didn't happen in a vacuum. It was the culmination of 25 years of escalation. A slow-motion collision between American power and Venezuelan oil that was always going to end this way. To understand why a rumor could move global markets, you first have to understand what Venezuela represents. Not just a country, a symbol, a warning, a test case for what happens when you try to leave the dollar system. And that story begins with a man who asked a very simple, very dangerous question. The year is 1999. Hugo Chavez has just been elected president of Venezuela. He's not a banker, he's not an economist. He's a former military officer who spent 2 years in prison for a failed coup attempt. And he's asking a question that nobody in Caracas has dared to ask for 40 years. Venezuela sits on 303 billion barrels of proven oil reserves. That's more than Saudi Arabia, more than Canada, more than Iraq, Iran, and Russia combined. If you added up all the oil under Norway, the United States, and Mexico, you'd still have less than what's buried under Venezuelan soil. At today's prices, that oil is worth $24.2 trillion, That's roughly the size of the entire U.S. stock market sitting underground in one country. And Hugo Chavez wants to know, why are we selling it exclusively in U.S. dollars? Picture the scene in Caracas, 1999. Chavez is meeting with his new economic advisors. Most of them were trained at American universities. They explain how the system works. Venezuela pumps oil. American companies buy it. They pay in dollars. Those dollars go to Venezuelan banks. Venezuela uses those dollars to buy American goods, American weapons, American treasury bonds. The money flows back to the United States. Everyone wins. Chavez listens. Then he asks the question that will eventually get him targeted for regime change. Everyone wins, or America wins twice. Here's what most people get wrong about the petrodollar. They think it's just about oil being priced in dollars. That's like saying a casino is just about chips being a certain color. The color doesn't matter. What matters is who controls the chips, who prints them, who decides what they're worth, and who gets to confiscate them if you break the rules. The petrodollar isn't a currency arrangement. It's a control system. Let me show you how it actually works. When Saudi Arabia sells oil to Japan, Japan doesn't pay in yen. It pays in dollars. To get those dollars, Japan has to either sell goods to Americans or borrow dollars from American banks. Either way, Japan needs America's permission to buy Saudi oil. Now multiply that by every oil transaction on Earth. 100 million barrels per day, $36.5 trillion per year. All flowing through the dollar system, all requiring American financial infrastructure, all subject to American rules. This creates what economists call structural demand for dollars. Every country needs dollars just to keep the lights on. That demand props up the dollar's value. It lets America run massive trade deficits without consequences. It lets America borrow at lower rates than any other country. It lets America print money without triggering immediate inflation because the world absorbs those dollars. Think about this in terms you might understand from your own life. Imagine you run the only gas station in a small town. But here's the twist, you also print the money. Everyone needs gas to get to work, so everyone needs your money. You can print as much as you want. You can buy whatever you want. You can run up debts forever because people have no choice but to accept your paper. That's America's position in the global economy. Not because Americans work harder or innovate better, because America controls the gas station and the printing press. Hugo Chavez understood this intuitively, and in 2000, he started doing something that alarmed Washington far more than any socialist rhetoric ever could. He started selling oil outside the dollar system. Carlos Mendoza was 29 years old when he witnessed the first crack in the petrodollar. He worked in the contracts department at PDVSA, Venezuela's state oil company. In August 2000, he was processing paperwork for a new deal, 200,000 barrels per day, to China payment in a mix of yuan and direct goods exchange. No dollars. He remembers his supervisor's hands trembling as he signed the authorization. "This is either the smartest thing we've ever done," his supervisor said, "or the last thing we ever do." The deals accelerated. In 2001, Chavez passed a hydrocarbons law, giving Venezuela majority control over all oil projects. American companies like ExxonMobil and ConocoPhillips had operated there for decades. Chavez told them, accept minority ownership or leave. Most left. In 2005, China loaned Venezuela $50 billion for infrastructure. Venezuela repaid the loans by shipping oil, not dollars, just oil. By 2008, Chavez was standing at the United Nations calling for the end of dollar hegemony, proposing a new Latin American currency called the sucre. And here's the first mini-climax. In 2002, there was a coup. Chavez was briefly removed from power. The U.S. denied involvement, but declassified documents later confirmed the CIA had provided support to coup plotters. The coup failed. Chavez was back in 48 hours, but a message had been sent and received. Remember Abdullah al-Rashid from Part 1. the Saudi wealth fund advisor who realized the difference between strength and enforcement. He told me something that still echoes. We watched Venezuela in 2002 very carefully. The Americans said it was about democracy, but Chavez was democratically elected. The Americans said it was about human rights, but Saudi Arabia has no elections, and we're their closest ally. We understood. It was about the dollars. It was always about the dollars. Let me ask you a question. If a country can be overthrown for selling oil in non-dollar currencies, is the petrodollar a voluntary system? Or is it something else? Chavez died in 2013. Nicolás Maduro took over. He continued the same policies, deepening ties with China, expanding barter deals with Russia and Iran, moving more oil sales outside the dollar. And the American response escalated from soft pressure to total economic warfare. In 2017, the Trump administration didn't just sanction Venezuela. They weaponized the entire global financial system against it. They banned American companies from buying Venezuelan oil, cutting off $13.7 billion in annual revenue overnight. They froze $7 billion in Venezuelan government assets held in American banks. They prohibited insurance and shipping services for Venezuelan oil tankers, making it nearly impossible to export, even to countries willing to buy. They banned the sale of spare parts and technology to PDVSA. The scene I keep coming back to is from January 2019. Maria Santos, a 47-year-old maintenance engineer at a PDVSA refinery in Puerto La Cruz, watching the production numbers collapse in real time on her monitoring screen. She'd worked there for 23 years. She'd seen oil production fall before, during strikes, during accidents, during political crises. But this was different. This was systematic. The equipment was failing because they couldn't get parts. The tankers were sitting idle because no one would insure them. Production fell from 2.4 million barrels per day in 2016 to 500,000 by 2020, an 80% collapse. Not from war, not from natural disaster, from financial strangulation. But here's the unexpected twist. It didn't work. Not the way it was supposed to. The US called this maximum pressure. The goal was to collapse the economy so completely that Venezuelans would overthrow Maduro themselves. Hyperinflation hit. GDP fell 75%. Millions fled the country. The suffering was immense and real. But Maduro didn't fall, and something else happened that Washington didn't anticipate. Venezuela adapted. They sold oil to China in yuan. By 2025, China was buying 600,000 barrels per day, $16.4 billion per year, $0. They sold to India in rupees. They created barter systems with Russia and Iran oil, for wheat oil, for gasoline oil, for machinery, no currency at all. By 2025, roughly 90% of Venezuelan oil production was being sold in non-dollar currencies or direct goods exchange. $23.2 billion in annual oil sales, completely outside the American financial system. The sanctions didn't destroy Venezuela's ability to sell oil. They destroyed Venezuela's need for dollars to do it. And 40 countries watched and learned. If Venezuela can survive outside the dollar system, yes, with pain, yes, with suffering, but survive, maybe we can too. Maybe we should start building alternatives before we become the next target. Russia watched. After the US froze $300 billion in Russian reserves in 2022, they accelerated everything. Rubles yuan barter. 5 million barrels per day. $137 billion per year, all outside the dollar. Iran watched. They formalized yuan-based oil sales to China, 1.5 million barrels daily, $41 billion annually, no dollars. Saudi Arabia watched. And in 2023, Crown Prince Mohammed bin Salman said publicly that Saudi Arabia was open to selling oil in other currencies. Everything I've shown you so far, Chavez's defiance, the coup attempt, 25 years of escalation. The sanctions, the survival that was just the entrance fee. What happened in January 2026 would reveal exactly how far the United States was willing to go to maintain the system. And once that was revealed, once the world saw the enforcement mechanism stripped naked, the collapse accelerated beyond anything Washington could control. January 3rd, 2026. The moment the rumor hit the wires, something shifted in the global financial system that can never shift back. Let me walk you through exactly what happened in those first 120 minutes, because the sequence of events tells you everything you need to know about how fragile the dollar system had become. 2:33 a.m. Singapore time. A Bloomberg terminal flashes an unattributed headline: U.S. forces reportedly detain Venezuelan President Maduro. No source, no confirmation, just 12 words that would move $2.3 trillion in assets before sunrise. Remember Marcus Chen from Part 1. The oil futures analyst staring at his screen in Singapore. He was one of the first to see it. Within 30 seconds, he watched Brent crude tick up $1.40, then $2.80, then $4.60. He told me later, "I've traded through wars, through pandemics, through OPEC surprises. I've never seen price move that fast on unconfirmed information. It was like the market had been waiting for this, like everyone already believed it was coming." By 2:47 a.m., 14 minutes after the first headline, China's foreign ministry spokesperson was walking to an unscheduled press podium in Beijing. 14 minutes. Think about what that means. The Chinese government doesn't hold emergency press conferences for rumors. They had been monitoring something. They knew something. Or they believed something was imminent. The spokesperson's words were carefully chosen. If these reports are accurate, this represents a grave violation of international law and the sovereignty of a UN member state. China demands an immediate explanation. Notice the construction. If these reports are accurate. Not these reports are false. Not we have information suggesting otherwise. The Chinese government, with all its intelligence capabilities, was not denying it. They were demanding explanation. That's when traders knew this wasn't a hoax. Here's the first twist most people miss. The market reaction wasn't about Venezuela. Venezuela only produces 900,000 barrels per day. That's less than 1% of global supply. A disruption to Venezuelan oil, even a total shutdown, shouldn't move prices more than $2 to $3 per barrel. Oil spiked $11. That's a $1.1 billion daily increase in global oil costs. The math doesn't work unless you understand what traders were actually pricing in. They weren't pricing in Venezuelan supply disruption. They were pricing in regime change as enforcement mechanism. They were asking if the U.S. just captured a president to protect the petrodollar who's next Saudi Arabia. If they accelerate yuan deals, UAE, Nigeria, Iraq. The risk premium wasn't about one country. It was about the entire system. Micro hook. What I'm about to show you is the moment 40 countries simultaneously decided to exit the dollar. Not over months, not over years, in one afternoon. And the U.S. government's own response made it happen. Picture the scene at the White House, 3:15 p.m. Eastern Time on January 3rd. Press Secretary Sarah Mitchell walks to the podium. Every major network is carrying it live. Foreign ministers in 40 capitals are watching. Central bankers are watching. The question everyone needs answered: did the United States just kidnap a foreign head of state? Mitchell's exact words: "We do not comment on ongoing operations. I would refer you to the Department of Justice regarding any law enforcement matters related to the 2020 indictment." Not a denial, an evasion. And in diplomacy, an evasion is confirmation. What most people get wrong about this moment is they think the U.S. was being strategic. They think the ambiguity was intentional, designed to project power while maintaining deniability. That's not what happened. What happened is the U.S. government didn't know how to respond because they hadn't anticipated that the mere rumor would cause this much damage. They were improvising, and their improvisation made everything worse. Let me show you what happened in the next 6 hours across 3 continents. In Riyadh, Crown Prince Mohammed bin Salman called an emergency meeting of his Economic Council. Ahmed Hassan, a 51-year-old deputy finance minister, was pulled out of his daughter's wedding reception to attend. He arrived still wearing his ceremonial bisht. The meeting lasted 4 hours. By the end, Saudi Arabia had authorized immediate acceleration of yuan oil negotiations with China. A deal they'd been delaying for 2 years was now urgent. Ahmed told a colleague afterward, "We always knew this was possible. We just hoped we'd have more time to prepare." In Moscow, the Russian Security Council convened at 11 p.m. local time. Foreign Minister Lavrov connected via secure video from New York, where he'd been attending UN meetings. Russia announced suspension of all bilateral talks with the United States pending clarification of the Venezuela situation. More importantly, they accelerated implementation of their non-dollar oil payment systems. Every contingency plan they'd developed since 2022 was activated. In Beijing, Dr. Mei Lin, remember her from Part 1. The economist at China's Foreign Exchange Administration was working through the night. She was drafting a memo that would land on the desk of China's State Council within 48 hours. The memo's recommendation, immediate reduction of U.S. Treasury holdings by $200 billion over 6 months, accelerated yuan internationalization, and formal launch of the BRICS alternative payment system by Q4 2026 instead of the planned 2028 timeline. She didn't know it yet, but her memo would become policy within 3 weeks. Pause this video for 10 seconds. Consider what you just heard. In one afternoon, because of an unconfirmed rumor that the U.S. government refused to deny Saudi Arabia accelerated its exit from petrodollar exclusivity, Russia activated contingency plans to bypass the dollar entirely, and China began drafting the blueprint to end American financial hegemony. That's not conspiracy theory. That's documented diplomatic response. Now continue watching because what happened next was even worse. Here's the second twist. By day 3, Venezuelan state media showed Maduro alive, speaking to supporters at an undisclosed location. He called the reports psychological warfare. He appeared calm, unharmed, still in power. The immediate crisis seemed to pass. Markets partially recovered. Headlines moved on. But the damage was already done. And it was the recovery that proved it. Oil didn't go back to $76. It settled at $82. A $6 permanent increase. That's $600 million per day in additional global oil costs that never went away. Why? Because the risk premium was now structural. Markets had priced in the possibility of petrodollar enforcement forever. Every barrel of oil traded from that day forward carried an invisible tax, the cost of uncertainty about whether your government could be next. Picture 2 photographs side by side. The first is from January 2026, Nicolás Maduro, president of a country with the world's largest oil reserves, appearing on state television to prove he's still alive because an unconfirmed rumor about his capture crashed global markets. The second is from 2019, Donald Trump hosting Mohammed bin Salman at the White House, all smiles and handshakes, while the CIA's own assessment confirmed MBS ordered the murder and dismemberment of journalist Jamal Khashoggi. Maduro never killed an American journalist. He never ordered anyone dismembered. His crime was selling oil in yuan instead of dollars. MBS killed a Washington Post columnist and he got state dinners. Maduro diversified currency payments and he got, according to the rumor, the U.S. wouldn't deny captured by special forces. Write that down. Remember it the next time someone tells you American foreign policy is about democracy or human rights. Let me ask you a direct question. If you were the leader of an oil-exporting nation watching this unfold, what would you conclude? That staying in the dollar system keeps you safe, or that the dollar system is a trap you need to escape before the door closes? 43 countries reached the same conclusion simultaneously. Micro-hook. Within 72 hours of the Maduro incident, something unprecedented happened. 14 countries representing 3.8 billion people issued a joint statement announcing plans for an alternative international payment system. Not someday. Now. And the list of signatories tells you everything about where the world is heading. The statement came from China, Russia, Brazil, India, South Africa, Iran, Turkey, Indonesia, Saudi Arabia, UAE, Egypt, Argentina, Venezuela, and Nigeria. Read that list again. That's 43% of global GDP. That's 4 of the top 10 oil producers. That's the manufacturing base of the world and the emerging consumer markets of the next century. The statement's key phrase, financial sovereignty and independence from coercive mechanisms. Diplomatic language for we do not want to be Venezuela. Gabriela Ortiz was a 38-year-old economic attaché at Brazil's embassy in Washington when she transmitted the joint statement to the State Department. She'd worked in D.C. for 6 years. She had American friends, American colleagues, and American education. She believed in cooperation between Brazil and the United States. She told me the conversation with her State Department counterpart lasted 3 minutes. They didn't argue. They didn't threaten. They just went quiet, like they were watching something collapse in slow motion and didn't know how to stop it. Here's the rage moment. Here's what should make your blood boil if you're an American taxpayer. For 50 years, you paid for the military that enforced the petrodollar. You paid for the aircraft carriers stationed in the Persian Gulf. You paid for the CIA operations, the sanctions regimes, the diplomatic pressure campaigns. Trillions of dollars over decades. And what did you get in return? The promise that the dollar would remain strong, that your savings would hold value, that America's position at the center of global finance would deliver prosperity. Now look at what happened in January 2026. The system you paid to build and maintain was revealed to be so fragile that an unconfirmed rumor could crack it. The enforcement mechanism you funded was so counterproductive that using it or even being suspected of using it accelerated the very collapse it was supposed to prevent. You paid for a protection system that made you less protected. Rosa Mendez, the former PDVSA accountant from Part 1, who now runs a grocery store in Caracas, watched the international reaction on a small television behind her counter. Her daughter had stopped texting frantically. The immediate fear had passed. But Rosa felt something else. Vindication maybe, or exhaustion. She told a customer, "For 20 years they said we were paranoid. They said the Americans weren't really trying to destroy us. They said it was our own fault. Now the whole world sees. Now everyone understands." The petrodollar didn't die in January 2026, but it was mortally wounded. The perception that sustains it that the dollar is the safe choice, the stable choice, the voluntary choice, that perception shattered. And once you see the enforcement mechanism, once you understand that the system is maintained through the threat of capturing presidents, you can't unsee it. You can't go back to believing it's voluntary. 43 countries saw it, and they started building exits. The question now isn't whether the petrodollar will end. The question is how fast. And what happens to the 330 million Americans who built their entire economy on the assumption that it would last forever. Everything I've shown you so far, the rumor, the panic, the diplomatic cascade, the joint statement that was week 1. What followed over the next 6 months would transform the global financial architecture more than any event since Bretton Woods. And the cost of that transformation will be paid by people who had no say in any of it. People like you. The petrodollar doesn't collapse like a building. It bleeds out like a patient who refuses to acknowledge the wound. Let me show you what the next decade looks like, mapped through the lives of people who will pay the price and people who will collect the profits. Because the consequences of January 2026 aren't abstract. They're measured in grocery bills and retirement accounts and children who can't afford the lives their parents had. Start with the timeline. Imagine a graph stretching from January 2026 to December 2035. The vertical axis measures dollar purchasing power. The horizontal axis measures time, The line doesn't crash. It slopes downward slowly, at first, then steeper still. A 4% decline in year 1, an 8% decline in year 2, a 12% decline in year 3. Compound those losses, and by 2035, the dollar has lost 41% of its purchasing power against a basket of global currencies. That's not hyperinflation. That's not Weimar Germany or Zimbabwe. That's something more insidious. It's slow enough that most people don't notice until it's too late. It's fast enough that it destroys retirement plans and college savings and middle-class wealth accumulation. It's the worst kind of decline, the kind you can't see coming until you're already drowning. James Morrison was 58 years old in January 2026, a maintenance supervisor at a Ford plant in Dearborn, Michigan. He'd worked there for 31 years. He had $340,000 in his 401k invested mostly in U.S. stocks and bonds. He planned to retire at 65, maybe buy a small fishing cabin in northern Michigan. His wife Patricia worked part-time at a medical clinic. They'd done everything right. Saved consistently. Avoided debt. Lived below their means. By 2030, James is still working. He has to be. His 401k is worth $380,000 on paper, a modest gain. But the dollar has lost 24% of its purchasing power. In real terms, his retirement fund buys what $289,000 bought in 2025. The fishing cabin he wanted costs $285,000 now, up from $180,000 in 2025. He can't afford it. He'll work until 70, maybe longer. Patricia had to go back to full-time work. Their grandson's college fund won't cover 2 years of tuition anymore. But the visible loss was just the beginning. The hidden consequence would take a decade to measure. Wei Zhang was 58 years old in January 2026, a quality control supervisor at a BYD electric vehicle plant in Shenzhen, China. He'd worked there for 12 years after transitioning from a state-owned manufacturer. He had 2.1 million yuan in savings, about $290,000 at 2026 exchange rates, split between Chinese government bonds, a small apartment in Dongguan, and shares in Chinese tech companies. He planned to retire at 63, help his daughter with childcare, maybe travel to see the Great Wall sites he'd never visited. By 2030, Wei has already retired. His 2.1 million yuan is now worth the equivalent of $412,000 in purchasing power, thanks to the yuan's 28% appreciation against the dollar. His apartment in Dongguan has tripled in value as the Pearl River Delta becomes the manufacturing capital of a multipolar world. His daughter works at Huawei's new AI research center. His grandson will attend university tuition-free under expanded government education programs funded by China's trade surplus. Same skills, same work ethic, same age. Different sides of the Pacific. James is calculating whether he can afford to retire before he dies. Wei is planning which historical sites to visit next spring. Here's the first question you need to sit with. Did James Morrison do anything wrong? Did he fail to work hard enough, save enough, plan enough? Or was he simply born in the wrong country, at the wrong time, holding the wrong currency when the music stopped? The pattern accelerates after 2027. That's when Saudi Arabia announces that 50% of oil sales to Asian customers will be settled in yuan or local currencies. This is the trigger event that Abdullah al-Rashid, the Saudi wealth fund advisor from Part 1, had been preparing for. He'd spent 3 years quietly restructuring the fund's holdings, reducing dollar exposure from 68% to 41%. Increasing yuan and euro positions, adding gold reserves. When the announcement came, he wasn't surprised. He'd helped draft it. The market impact was immediate. Oil spiked to $118 per barrel within 2 weeks. The dollar fell 7% in a month. U.S. Treasury yields rose 180 basis points as foreign central banks accelerated their selling. The Federal Reserve was forced to raise interest rates to 7.5% to defend the currency, triggering a recession that officially began in Q3 2027. Visualize the map of global oil flows in 2028. In 2020, 82% of global oil transactions were denominated in dollars. By 2028, that number is 54%. The remaining 46% flows through yuan euros, rubles, rupees, and direct barter arrangements. The petrodollar hasn't ended, but it's no longer dominant. It's just one option among several. And that shift alone costs the United States $340 billion per year in lost seigniorage and reduced demand for treasury bonds. Maria Santos, the PDVSA maintenance engineer from Part 2, who watched Venezuelan oil production collapse under sanctions, is still in Puerto La Cruz in 2028. But everything around her has changed. Chinese investment has rebuilt the refinery where she works. Production has recovered to 1.4 million barrels per day. She's training a new generation of engineers Venezuelans who grew up during the crisis years, who studied in China on government scholarships, who returned to rebuild their country's oil infrastructure using Chinese technology. Her salary, paid in a mix of bolivars and yuan, has real purchasing power again. Not wealth. Venezuela is still recovering from 20 years of economic warfare, but stability. Her grandchildren have enough to eat. The hospital has medicine. The lights stay on. She tells a visiting journalist, "They tried to starve us into submission. They failed. And now the whole world is learning what we learned. You can survive outside the dollar. It hurts, but you survive." Same profession, same country, different decade. Maria went from watching her industry collapse to watching it rebuild without American permission or American currency. But the hidden consequence would take decades to measure. The loss isn't just economic, it's positional. It's the slow erosion of American influence in every negotiation, every treaty, every international institution. Let me ask you a direct question. When the dollar was supreme, American diplomats could make demands. American sanctions could cripple economies. American financial institutions could veto transactions anywhere on Earth. What leverage does America have when 40 countries can simply root around the dollar system entirely? The answer is military force, and that's exactly what the Maduro incident revealed. When economic leverage fails, the only remaining tool is violence. But violence, as we've seen, accelerates the very collapse it's meant to prevent. Here's the first unexpected twist. The countries that suffered most from petrodollar decline weren't in the global south. They were American allies who stayed loyal to the dollar too long. Picture Japan in 2029. For decades, Japan held over $1 trillion in U.S. Treasury bonds, the largest foreign holder. They believed in the alliance. They trusted the system. They didn't diversify when China and Saudi Arabia and Russia were diversifying, because they thought loyalty would be rewarded. By 2029, those treasury holdings have lost 31% of their real value. Japan's national wealth fund has been gutted. The government faces a choice between cutting pensions and cutting defense spending. They choose pensions. An entire generation of Japanese retirees sees their standard of living fall because their government trusted the wrong currency. South Korea, same story. Australia, same story. The countries that believed American promises most deeply are the ones who paid the highest price when those promises proved empty. Kevin Park was 44 years old in 2026, a mid-level finance manager at Samsung Securities in Seoul. He managed institutional accounts worth $2.3 billion, heavily weighted toward dollar-denominated assets. He'd been trained at Wharton. He believed in American financial markets. He counseled his clients to stay the course when others were diversifying. By 2031, Kevin has been demoted twice. His clients lost 28% of their real purchasing power. Several sued. Samsung's compliance department investigated whether he'd been negligent in not recommending diversification when the warning signs were clear. He wasn't fired. That would require admitting the firm's own strategy was flawed, but his career is over. He's 49 years old, managing a small domestic bond portfolio, watching younger colleagues who invested in yuan assets get promoted past him. His counterpart at KB Financial Group, Min Ji Choi, was also 44 in 2026. She ignored her American training. She moved her clients into a diversified basket: 30% yuan, 25% euro, 20% gold, 15% emerging market currencies, only 10% dollars. Her colleagues called her paranoid. Her supervisors questioned her judgment. By 2031, she's a senior managing director. Her clients outperformed by 34%. She's being recruited by sovereign wealth funds across Asia. Same training, same starting point, same country. Different judgment about which empire was rising and which was falling. Now let me show you the pattern. Because what happened to Venezuela wasn't unique. It was a template. Iraq in 2000. Saddam Hussein announced he would sell oil in euros instead of dollars. Within 3 years, he was dead, and Iraq was occupied. Libya in 2011. Muammar Gaddafi proposed a gold-backed African currency and began selling oil outside the dollar system. Within months, NATO intervened. He was killed by a mob on camera. Iran under sanctions for decades, building alternative payment systems, constantly threatened with military action. Russia in 2022, frozen out of SWIFT, $300 billion in reserves, seized, now trading oil entirely outside the dollar. Venezuela, 25 years of escalating pressure, culminating in an incident so ambiguous that even the rumor of military capture was enough to trigger global panic. 5 countries. 5 attempts to exit or challenge the dollar system. 5 massive retaliations, military, economic, or both. If the same mechanism produces the same results in 5 different countries over 25 years, is it a bug or a feature? The feature is discipline. The message to every oil exporter, every emerging economy, every country that might consider an alternative: leave the dollar and we will destroy you. But here's the second unexpected twist. The discipline stopped working. Remember Dr. Mei Lin from Part 1? The Chinese economist whose classified memo recommended accelerating de-dollarization. Her memo became policy. China reduced treasury holdings by $280 billion in 18 months. They launched the digital yuan for international oil settlements. They provided alternative financing through the Asian Infrastructure Investment Bank. They built the architecture for a non-dollar world while the U.S. was still debating whether the threat was real. By 2030, the BRICS currency basket is operational. It's not replacing the dollar, not yet, but it's providing an alternative. Countries under U.S. pressure have somewhere else to go. The discipline mechanism only works if there's no escape route. China built the escape route, and this brings us to the present. Because the system designed in 1974, when Nixon and Kissinger convinced Saudi Arabia to price oil exclusively in dollars in exchange for military protection, that system is still operating today. But it's operating on fumes. Every sanction, every freeze, every threat accelerates the exodus. Every country that survives outside the dollar proves it can be done. The petrodollar isn't dead, but it's dying. And the people who will pay the price aren't the architects who built it or the politicians who weaponized it. The people who will pay are ordinary Americans who did everything right, worked hard, saved diligently, trusted the system, and woke up one day to discover their life savings by half of what they expected. The question isn't whether this will happen. The infrastructure is already being built. The deals are already being signed. The question is what you do with the time that remains. So where does this leave us? Not in some distant future, right now, today, in a world where the patterns I've shown you are still unfolding. January 2025. As I'm recording this, oil trades at $76 per barrel. The dollar index sits at 108. U.S. Treasury debt has crossed $36 trillion. China holds $770 billion in treasuries, down from $1.3 trillion 5 years ago. Saudi Arabia is accepting yuan for oil sales to China. Russia hasn't touched a dollar for energy exports in 3 years. The BRICS nations are meeting quarterly to discuss reserve currency alternatives. These aren't predictions. These are today's headlines. Picture a timeline stretching across your screen. On the left, 1974, Nixon and Kissinger create the petrodollar with Saudi Arabia. In the middle, 2000 to 2025, a cascade of countries attempting to exit and facing retaliation. Iraq, Libya, Iran, Russia, Venezuela. On the right, a question mark. The timeline continues, but the pattern is clear. 50 years of the same mechanism, producing the same results, facing the same resistance. Let me ask you directly. When you read news about sanctions on a country, about regime change operations, about frozen assets and financial isolation, what framework do you use to understand it? Most people accept the official narrative. Human rights, democracy, terrorism, weapons of mass destruction. But now, you've seen the pattern beneath the pattern. Now you know what question to ask first. Here's a framework, not financial advice. I'm not telling you what to buy or sell, but a way to see clearly when the next crisis emerges. When you hear about a country being sanctioned, ask what currency are they selling their oil in. When you hear about a leader being demonized, ask, did they recently announce plans to trade outside the dollar? When you hear about frozen assets and financial warfare, ask who benefits from keeping that country inside the system, and what happens to dollar demand if they successfully leave. These questions won't give you answers, but they'll show you which questions aren't being asked on the evening news. Marcus Chen, the oil futures analyst from Singapore, is still trading. He's 35 now. He's become something of a specialist in what his firm calls geopolitical risk premiums, the invisible cost that gets priced into every barrel of oil because traders know the system is backed by force. He told me recently that his models have fundamentally changed since January 2026. He no longer asks whether oil supply will be disrupted. He asks whether the currency the oil is priced in will still be dominant when the contract settles. His 8-year-old daughter is learning Mandarin in school. Not because Marcus is Chinese, his family has been in Singapore for 4 generations, but because he's watching where the world is heading and adjusting accordingly. I trade the present, he said, but I'm raising her for the future. Rosa Mendez is still running her grocery store in Caracas. She's 53 now. The shelves are fuller than they've been in a decade. Chinese investment rebuilt the local oil infrastructure. Venezuelan crude flows to Asia paid for in yuan, and goods completely outside the system that tried to strangle her country. She doesn't think about the petrodollar or reserve currencies or geopolitical grand strategy. She thinks about whether her grandson will have opportunities she never had. For the first time in 20 years, she believes he might. Same world. Same moment in history. Different positions in the system. Different futures unfolding. Here is the contrarian point that challenges even this narrative. There is no shadowy cabal meeting in secret rooms to plan dollar hegemony. No single villain orchestrating the system. The petrodollar emerged from rational decisions made by rational actors pursuing their interests. Nixon needed to stabilize the dollar after abandoning gold. Saudi Arabia needed military protection from regional rivals. American consumers wanted cheap imports. American politicians wanted to fund deficits without consequences. Everyone got what they wanted for a while. The system doesn't require evil intent. It only requires self-interest applied consistently over time. That's what makes it so durable. And that's what makes it so dangerous when it starts to fail. Because no one is in control. No one can stop it. Everyone is just optimizing for their own position while the ground shifts beneath them. Abdullah al-Rashid, the Saudi wealth fund advisor, who realized the difference between strength and enforcement, retired last year. He's 59. He lives in a compound outside Riyadh, plays with his grandchildren, reads history books. He told me he's been studying the British Empire lately. How the pound sterling was the world's reserve currency for over a century. How the transition to dollar dominance happened gradually, then suddenly. How the British public didn't understand what they'd lost until decades after they'd lost it. Americans think this is about economics, he said. It's not. It's about identity. When you've been the center of the world for so long, you can't imagine being anything else. That's why they won't adapt until it's too late. Understanding this history won't tell you what to do specifically. That's not the point. The point is to see the pattern so that when the next country gets sanctioned for selling oil in the wrong currency, when the next leader gets demonized after announcing a gold-backed regional currency, when the next humanitarian intervention happens to target a nation sitting on resources priced in non-dollar terms, you'll recognize the mechanism. You'll see what's actually being protected, and you'll understand why. Let me take you back one final time to that trading floor in Singapore. January 3rd, 2026, 2:47 a.m. Marcus Chen staring at his Bloomberg terminal. The Reuters alert flashing. Brent crude spiking $11 in 2 hours on an unconfirmed rumor. He processed the trades, closed his positions at 4 a.m. and took a taxi home as the sun rose over Marina Bay. He had no idea that in Riyadh, Abdullah al-Rashid was accelerating Saudi Arabia's exit from dollar exclusivity. He had no idea that in Beijing, Dr. Mei Lin was drafting a memo that would become Chinese state policy within 3 weeks. He had no idea that in Caracas, Rosa Mendez was packing a bag she wouldn't need, preparing for a crisis that would pass but leave permanent scars. He had no idea he'd just witnessed the moment the petrodollar's mortality became visible to everyone paying attention. What the file doesn't show. What no Bloomberg terminal captures. The retirement accounts that will lose half their real value over the next decade. The factory workers in Michigan and Ohio, who will never understand why their purchasing power keeps falling despite working harder every year. The allied nations who trusted American promises and will watch their sovereign wealth funds bleed out slowly. The children being born today who will inherit a world where American financial supremacy is a history lesson, not a lived reality. The mechanism is still operating. Right now. Today. Sanctions on Russia driving them deeper into yuan. Pressure on Iran accelerating their alternative payment systems. Threats against any nation that considers pricing oil in something other than dollars. Every enforcement action intended to preserve the system pushes more countries toward the exit. Empires don't fall when they run out of power. They fall when the cost of maintaining power exceeds the benefits of having it. If the whole world now believes the dollar is enforced through capture and coercion, does it matter anymore whether Maduro was actually taken? The rumor was enough. It was always going to be enough. Because the system was never built on trust. It was built on fear, and fear once seen clearly loses its power.